Navigating Market Dynamics with Multicap Strategy webinar. I'm Nidisha and I'm the Vice President Market Insights at WPB HSBC India. The year just doesn't seem to get any better than this. With the elections uncertainty behind us, the investor confidence is scaling new highs and is evidently visible in the movement of the benchmark indices. Structural growth story, domestic flows, and strong corporate earnings are fueling the positive narrative. While there is abundance of opportunities, the adoption of an effective strategy is of prime importance to optimize the opportunities and balance risk. With this line of thought, we would like to welcome our expert speaker for today, Mr. Kiran Sebastian. He's the Senior Fund Manager of Franklin Templeton India AMC. He has almost 2 decades of experience in fund management and research and has worked with marquee organizations in India and globally. I shall now like to hand it over to Kiran to share his outlook, post which we shall be happy to take questions from you. Over to you, Kiran.
Thanks, Nidhi, for that introduction and for setting the context. So I will talk a little bit about what's happening to Indian economy, what's happening to some of the sectors, what is the kind of growth we are seeing. And I will introduce the concept of a multi-cap product, and then we can explore how that fits within the strategy of some of the clients. So I'm going to share my screen now. So just to talk about the Indian economy itself, right? So on the right-hand side, you can see the real GDP growth rate projection for India. India is expected to grow around 6.5 to 7% real GDP in the medium term. So the gray bar is for FY25. China has been clearly slowing down. US is also a bit soft, it's weakening, and US is growing at below 2%. Eurozone is also struggling. So that makes India the largest or the fastest growing large economy. India currently is number 5 in terms of the GDP size, and it is expected to become number 3 in a couple of years from now. And what is driving this? Firstly, in terms of macros, we don't have any major concerns. Our inflation is fine. We don't have any current account problems. Our industrial growth is fine, and government has been taking various policies to stimulate growth over the past decade. And all of it is coming together to make the India growth story really attractive. So this is the corporate profits to GDP trend. So what you can see is the corporate profits to GDP was about 2% at the beginning of the century, went as high as about 8%. Then it went back to 2% during COVID. So the way I think about this, so the economic growth happens in cycles, right? So every economy has a trend rate of growth, but it's a bit cyclical around that trend. And what we can see is here during this time frame are the last 2 cycles of India. So I would split up this period, from FY4 or FY5 to FY12. That was a investment driven economic cycle. And you could see capacity expansion in multiple industries like power, in many commodity sectors, because commodity prices really went up in that decade. So refineries, metals, and of course the housing market also went on a capacity expansion spree. And eventually it did not end very well. There was speculative building of apartments. There was excess capacity creation in terms of thermal power plants and various factories. So what followed after this cycle, what followed after FY12 was a very weak cycle in terms of the investment driven growth of the economy. So it was an environment of supply being greater than demand. You can take a real estate market, for example, or many other capital goods market like transformers or industrial goods, etc. So that was generally a very anemic period of growth. But what was very clear during that time was that in many of the industries and of course the housing market, the excess inventory or the excess supply that was present that was getting absorbed, and the slack was getting taken away by the underlying growth of the economy. But because of the pessimism following the previous cycle, generally investment or capex was frowned upon, and the corporate sector, private sector did not have the confidence. The banks were not happy to lend to these kind of projects. So we saw quite a bit of underinvestment during that period. So that is the period from FY12 to around FY20. And post COVID, what we are seeing is the beginning of a new cycle. When the economy reopened, the people moved back to the cities, we realized that there is a supply shortage in multiple industries. There is a supply shortage in the housing market. So even the house prices have gone up materially in many markets. So we are at the beginning, early stages of an investment driven growth cycle, and typically an economic cycle can be a 7-year or an 8-year type of cycle, and we are not even halfway through in terms of that recovery cycle playing out. And when you talk about investment driven growth in an economy, there are three players who drive investment spending. One is the public sector, which is the government. Government has been trying to spend on infrastructure and trying to revive the capex cycle for a while now. The second is the private sector. They will spend when they feel confident about the future, when their balance sheets are healthy, and when their capacities are tight. And we are kind of getting there. And certain industries like steel, it's already visible that they have started to spend, and we are seeing them spending in many other industries. And the third player is the household sector, which is the residential real estate cycle, where a very similar story is playing out. The supply is limited, and the developers are seeing very strong bookings right now. And in the next 3 or 4 years, they will have to construct these houses and deliver. And what all of this means is that after nearly a decade, all the three drivers of asset creation in an economy, the public sector, the private sector, and the household sector, they are coming together to strengthen the cycle. And we believe this growth would sustain, and it would accelerate from here on for maybe another 3 or 4 years before the economy fully peaks out. Now, I talked about a very organic way in which an investment cycle picks up. This time around, there is something else also going on. This time, the government is also inducing an investment spending in the economy. And how are they doing it? They are doing it through an approach of incentives and barriers to import. So they want to create many of those strategic industries within India. And if you are willing to set up a local manufacturing facility for that, the government is giving you some form of a capex subsidy, which we call production linked incentive, because it is related to the what you're going to produce in a defined time period. And if you continue to import, government is putting a penalty on you in terms of putting a tariff or even a non-tariff barrier, like you are not allowed to import certain items if there is an Indian vendor available. So as a result of this, many new industries are mushrooming in the country, like semiconductors, you can see here, advanced chemistry cells for the electric vehicles, fully integrated solar modules for generating power, hydrogen electrolyzers for generating hydrogen out of the green power we are going to generate, assembly of white goods, electronic components, IT hardware, etc. So this is giving rise to many new industries like electronics manufacturing, semiconductors, energy transition related industries, etc. And of course, India is a very vibrant startup ecosystem, and this is giving rise to many digital internet driven business models also. And that universe actually is getting much richer. So we did not have too many of this new age type of businesses in the country 5 years ago. But now we are seeing that many such business models are emerging, and they are getting listed in the stock markets. So this, I'm just giving some examples. This is one new sector that has got created in the last few years, electronics manufacturing services. And you can see at least there are 4 stocks that have been growing at above 40% CAGR in the last 3 years. Similar story with internet or digital businesses. There are 4 or 5 stocks which are growing at more than 35% in the last 3 years. So many high growth sectors are emerging. So, how do we take advantage of this? When you look at where the IPOs that have happened in the last 3 years, in which size classification they have happened, 83% of them have happened within the small cap universe. And if you have large cap exposure, this is the kind of, you vertically look downward, that is the split of the large cap universe. So straight away banking is 28%, IT services 13, petroleum products 12. So straight away your 50% allocation is given to just 3 sectors. And when you look at the market as a whole, roughly the large caps account for 70% of the large cap or the market allocation. So market splits in terms of large cap, mid cap, small cap in the ratio approximately 70, 20, 10, as you can see here. So many sectors which you can see in the orange color here, like textiles or fertilizers, auto components, they don't even not captured in the large cap universe. They only exist within the small and mid cap universe. The sectors listed in the blue color, like chemicals, real estate, etc., they are a large part of that. Those sectors are present within the small and mid caps. So in many products, like let's say flexi cap products, I showed you about the market breakup, right? Many flexi cap products try to mimic the same market allocation. Maybe 70, instead of 70 it can be maybe 60, but they don't deviate too much from this allocation. So you might be under indexed or very underweight small caps when there is a lot of action happening in the small cap world. Now just moving on to what these indices are made of. So we know that the indices are made of different companies, and these different companies come from different sectors. And I told you, we are in a cyclical recovery of the economy. We are not even halfway through, and it looks like this is an investment driven cycle. So sectors like industrials, real estate, all of those sectors are going to see very strong growth. Now we ask the question, where are these sectors captured within the listed universe? So when you look at that, within the large cap index on the left hand side, you can see only 27% is coming from these kind of sectors. Whereas in the case of mid caps and small caps, it is something like 50% plus. So it is very clear that small caps capture the cyclical growth of the economy. And of course, other benefit or the other reason you should own small caps is because many of the emerging sectors are also captured there. Now, what is the catch? Then why not own small caps all the time? As you know, right, small caps are the weaker companies or the more vulnerable companies of the economy. Large caps are the proven companies, the very resilient companies, the large companies of the economy. So you can own a large cap portfolio through the cycle without worrying too much, because these are generally very healthy businesses. But many small cap companies, they go through deeper pain. They are more volatile. Fatality is higher in the small cap universe. So in a recovering phase, small caps tend to do better. When the economy is running into crisis, small caps do worse. So you can just look at the last data point. In the last 1 year, small caps have done 65%, when large caps did only 32%. Whereas in the COVID year, small caps fell 30%, while large caps fell only 17%. Now coming to how one should think about the returns from these asset classes at this point. So as you are aware that markets have run up quite a bit. Within that, small caps have done better than large caps. So many of you would have concerns, whether we should be in the equity market now, or not. So one way to look at it is, what is the earnings growth expected? Where is the starting valuation? So earnings growth wise, this is how the picture looks like. The large cap universe is expected to grow about 15 percentage, or Nifty 50, a large cap 100 large cap stocks will be around 16 percentage. The mid caps about 17 percentage, and small caps close to 22 percentage. So clearly, small cap earnings will grow faster because they are capturing the cyclical recovery, plus all the higher growth businesses might be there. Now, what should be the expected returns if you invest now? The way I think about it is that market multiples are on the higher side compared to history. Of course, we are not seeing any immediate reason why the markets should derate, because the story, India's story, is genuinely better than what it has ever been. But just to be conservative, we should assume that in the long run, the current multiples may not sustain. It will come off a little bit. If that is the case, the expected asset return will be a bit lesser than the earnings return in the next 3 years. So I work with a asset return expectation of about 12 to 13 percentage. So the last 1 or 2 years return should not be a benchmark. That was like, in my mind, that's like an exceptionally great period, but you cannot expect that to sustain. So I would have an asset class return of about 12 to 13 percentage. And using active management, we can generate some outperformance over and above that. That is how we look at it. Now coming to what is a typical multi-cap product structure, right? So by mandate, a multi-cap needs to invest 25% in large cap, 25% in mid cap, 25% in small cap. And in our multi-cap product, we have a unique framework for investing the remaining 25% based on a 3-factor framework. And so what do you gain by that? Why is that interesting right now? So we are at that point in the cycle where you want to strike the right balance, having that stability of large caps in the portfolio, at the same time being able to capture the excess returns and the alpha that is coming from the cyclical recovery and the high growth part of the economy, which the small caps can effectively capture. And the portfolio management team has some flexibility in terms of either moving the portfolio more to the large cap side or the small cap side. So, and this is also a diversified product that is compounding in nature. So it is something we can own across the cycle. So in that sense, I feel this is the right product to have at this point in the economic recovery cycle. Now we can, there are multiple layers of active asset management one can do over and above just allocating the sizes. Okay, so large, mid, small is one way you think about the market. Then you can do further value add. Am I capturing the most interesting themes in the markets? So this is one illustration of that. What it shows is that, so GDP per capita is increasing in this country. So the disposable incomes of the people would go up. Urbanization, so the percentage of people living in urban centers is only about 35-36% in India. Most of the developed countries, it's closer to 70%. So more people would move into the cities. So what does that mean? There will be more premium consumption. People might take credit to consume. You will need more housing in the cities. People might invest in financial assets. So then you can map them into where those stocks are in the sectors, and then you can pick stocks using your bottom-up stock picking framework. So what we have done here is one such example. We have kind of listed out many such themes that are available in the market, like premiumization, formalization, rising credit, digitalization. And we have said which sectors capture most of these opportunities, and then where are those opportunities available in the large cap, mid cap, or small cap. For example, if you want to play Make in India theme, within that you want to play EMS, which is the electronics manufacturing services, most of those ideas will be in the small cap. That's why the dark green is there. So there are different ways in which active asset manager can add value over that benchmark return. And of course, we have a bottom-up stock picking process, which we call QGSV, where we look at 4 factors called like quality, growth, sustainability, and valuation. Now, how does a multi-cap performance look like? When does it outperform? And what's been the historical reference in terms of the returns? How should one think about it? So these this brownish colored ones, which you can see on the top, that's a small cap, right? You can see here, Nifty small cap 250. So this is the annual returns of these asset classes, and the multi cap is a blend of 50% large cap, 25 mid and small. In reality, that 50% large can be modified a little bit. It has to be at least 25% large cap, but the remaining is up to our discretion. So so what it looks like is this. So one thing is very clear, right? We are in a recovery phase of the economy post COVID. So in 3 out of the last 4 years, small caps are at the top. So they have been the best performer in terms of the delivering alpha in the recovery phase. But you also know the economic growth was anemic prior to COVID, and the economy was actually slowing down. Even the auto volumes and some part of consumption was slowing down even before COVID. And you can see a mirror image of what happened after COVID. Before COVID, small caps were really underperforming for 3 out of 4 years. And you can see large caps, which are these blue ones. Lately, large caps are the underperformers. 3 out of 4 years, large caps are underperforming. So what multi-cap achieves for you is a middle of the road type of performance. And with an active manager who can move the weightage a little bit to large cap or small cap, you can enhance that return. This is a rolling returns chart. So in the last, from let's say 2008 onwards, on a 3-year rolling basis, if you had owned a multi-cap product versus owning a broader market proxy like Nifty 500, you would have been better off 69% of the time. So above the zero means you are outperforming the benchmark. Below means you are underperforming. So before COVID, you would have been underperforming because the small and mid caps were not working at all during that time. But now it's looking good. This is the historical returns of the asset class. So this is starting from April of 2005. So a theoretical multi-cap index, how much CAGR it would have delivered? The answer is close to 16.5%, which is very close to what small caps have delivered, close to 16.8. Right now, mid caps have delivered the best at around 18%. And Nifty is at 15% on the lower side. But when you look at 2019 or 2018, you can see the orange line is way below. That's the small cap. So multi-cap kind of strikes a right balance actually. Multi-caps did pretty decently then also. This is the expected earnings projection for multi-caps. So bang in the middle, around 17.5% for the next 3 years. This is for the universe that is made up of the multi-cap stocks. This is the peak to trough, how much these categories fall. So this is very important to be aware of, and important not to panic and do anything in a hurry when market volatility comes. So what this shows is that from the peak, how deep things can fall. So small caps have fallen as much as 76% during global financial crisis. During COVID, they fell very close to 60%, whereas large caps fell only 61%, and multi-cap fell around 66%. So much better than the small caps. this has to be a core allocation. This is a diversified fund with balanced allocation to the size categories, and this is something that you can consider as a core allocation. And these are the returns which you would have generated if you were invested in an SIP. So I think with that, I hope you got a reasonable handle on the asset, on the product, how a typical multi-cap product looks like. So just to summarize where we are in the cycle, we think we are in a economic recovery cycle with investments and capex dominating the recovery. The budget expectation could be that, at the margin, maybe something might be done for the rural side of consumption. Otherwise, it's going to be more of the same. That is how I see things going. And in this recovery cycle, many cyclical sectors are bouncing back, and also many new sectors are emerging, and they are better captured in the small and mid cap universe compared to large caps. And you need a product that offers the right balance between large cap, mid cap, and small cap exposures. And the product needs to be a compounding product that can build long-term wealth. And that's really where a product like multi-cap comes in. With that, I'll hand it over back to you, Nidhi, and I'll open it up for questions as well.
Thank you so much, Kiran. That was really quite insightful. Generally, we get to read about valuations, how they are more volatile, how the valuations are stretched, how the fundamentals don't connect with the premium valuation. But when you really look at how do you break down the India growth stories or the sectors which will really emerge from this entire domestic consumption story, you talk about structural or you talk about the investment driven cycle. So it really captures wherein we should look at. So really, thank you for bringing out those points. And we have host of questions, and I'll kind of pick it up one by one as we go ahead. So to start with, one question that everybody really talks about, in terms of categorizations of schemes. So we do have something known as a flexi cap, wherein it moves between various capitalization, and we do have a multi cap as well. So if somebody has to really understand, it just becomes a me too kind of a thing, or there is a clear distinct line between the two, and we should actually have a multi-cap as well. So if you could answer that question.
Yeah. So see, FlexiCap by design has the flexibility to be run like a multi-cap, right? So there the PM has the freedom to have any kind of market cap mix that they would like to have. But in reality, most of the products are run in a way that mimics the market weight allocation of that 70-20 10, or recently it's more like 60-40, something like that. But they don't deviate by more than 7 or 8%. So so that is that product. Whereas in multi-cap, the SEBI has mandated that by design you need to allocate 25, 25, 25. So then you only can play with the other 25. So that is how the products differ. Now you can see why, when multi-cap as a category was created, maybe when was it, 2018, 19, around that time frame, that was a period when small and mid caps were generally not working, right? I showed you in the chart that in the run up to COVID, 3 out of the 4 years, small caps were underperforming. So that time nobody had an incentive to overweight small caps in a flexi cap context. So I can understand why people kind of stuck to that allocation. And I guess now people expect, the product became branded like that, and people expect them to stick to that. That's how the expectations have been set.
So much for that. So moving from this thing, another question. So we spoke a little bit about valuations as well, very briefly. So definitely we saw the entire movement post the election results, and then we saw a complete turnaround. The benchmark indices are scaling new highs as we talk each day. So one of the questions that people really feel at this point in time I mean, I'm sure you've answered this question a number of times, have different valuation, but it comes back again and again. Is this the point really to enter or to make fresh investments, or what would be your take on the same?
So see, any time is good time to enter equities, but you have to enter in a good manner. So I might not enter something which is a very narrowly focused product, which betting on some theme that has already run up, something like that. But see, there are pockets of opportunities within the market. I told you that 70% of the markets is large caps, right? So large cap, uh, we have a lot of stocks with reasonable valuation there. Small caps is a very diverse universe. You can't just look at the 250 stocks in the benchmark and limit your universe to that. There are new stocks emerging. There are parts of the small cap universe that are out of favor. So it's a stock pickers universe, and you have to actively go and find those opportunities. Mid caps, of course, you have to be a bit more pragmatic, but I still feel that. So I told you the expectation one should have, right? The 12 to 13 percentage. With that kind of expectation, I think one can still create a robust portfolio. And generally, timing the market has never been a great strategy. In fact, from beginning of the year, people have been telling, don't get into small caps, liquidate. I think in the last 3 months alone, small caps have delivered 30%, right? So that's not ideal as a strategy. Volatility will be there. I mean, there is a reason equities deliver high returns. So I gave you the asset class return, right? The long-term asset class return was 16.5% for multi-caps, which is way above your FDs. And why you are able to achieve that? Because you are willing to take that volatility, that drawdown of 66%. This is for somebody who can live through that. And it's better to accept that volatility and live through it and have a strategy upfront and be in a diversified type of product than making that timing call. That's what I've learned repeatedly.
Thank you for putting it so simply. I mean, if you really follow the discipline and the strategy long term, it boils down to pretty simple decisions. So there are not too many ifs and buts if you have to really think that way.
Yeah.
Another question I'm sure you had covered about this thing that you allocate 25% to the different capitalization. But there is this thing, there's this question specifically. So I might just take it about, even if you see the market change drastically. For example, we looked at the period when COVID period was there, and 33% is where I believe small caps corrected, and 17% is where the large cap corrected. That was the period mentioned. So if we see a sudden turnaround, even if we don't really see that market changes drastically, would there be a possibility or a room to move lesser, like that 25% in small cap can go down, or those are like sacrosanct percentage limits that we have for these capitalizations?
That those 325s we can't move, that they are firmly fixed, large, mid, small. Only the remaining 25% we can move.
Okay. Thank you so much. Another question in terms of, I mean, we are very close to the budget. So what is that, couple of key expectations or couple of things which you feel, the government will balance between welfare schemes or capex, etc. What would be your 2 pointers or 3 pointers from the budget? What expectations would you
So
have?
it's a balancing act between three things to me. One is that fiscal glide path, wherein we want to control that and ensure that credibility is maintained. I think that will be done. Second is maintaining the growth, which will be more continuation of the capex and the incentives for new industries. It will be along those lines of stimulating the supply side of production, which is more of the same. And third is money in the hands of people. So that's a new thing, but generally they have been reluctant to do it. But there could be things there, maybe in terms of lowering the taxes at the lower end of the bracket, or stimulating rural construction, or in some form. There is an anticipation of something happening there. If that happens, I think it will be positive from a consumption standpoint, especially rural consumption standpoint. Otherwise, I'm expecting more of the same. Yeah.
You wanted to add something further, sorry.
No, no, I am not sure whether they will tweak around with capital gains, etc. I do hear these questions, but I'm not convinced that it's going to happen.
Yeah, I guess they wouldn't want to spoil the party in the markets, definitely.
Yeah.
So I'm sure I mean, yeah. Okay. So another question, we talked about the India growth story. Captured about the public spending, private spending, household spending. So you did mention a couple of sectors, for example, disposable income increases. But if you have to take three key sectors, Kiran, from this entire, putting all the factors that make the India growth story so strong, three pillars from the entire thing, which would that be?
So see, in the current cycle, purely from a growth standpoint, it will be manufacturing, industrials as a sector, energy, utilities, that entire energy transition. First of all, we need to set up more of traditional power generation capacity, and secondly, of course, we need to transition to greener fuels and the supply chains for that, and the entire grid and the distribution and the end use industries. All of that needs to change. That's another theme. And long term, we have always been a consumption market, so consumption also need to become more broad based in its recovery. So far, the affluent side of consumption has been solid, but the rural side has been a bit weak. But I expect in the next 6 months or so, the rural side would also recover and would join, and we'll have a more broader based recovery there.
And the third one, manufacturing, consumption, and
No, no, I said manufacturing. Second is utilities or power as a
okay,
sector.
power. Okay,
Yeah.
okay,
And third can
okay.
be consumption.
Consumption. Okay, great. Thank you. Another questions. You talked about, how large cap are pretty much the proven companies, those are visible one with proven track records, and small cap would be maybe, innovative technology, disruptive technology, or newer emerging sectors. But what would be the caveats, in terms of the small cap sector? Is it governance, if you feel, or is it you feel the ease of business, or something that needs to be specifically improved if we really want the small and the mid cap to develop further?
Um, so so many small caps become mid caps eventually, and see, there are companies with uh, good corporate governance in all market cap universes. So I wouldn't argue that necessarily uh, as a percentage small caps are companies with poor corporate governance. Of course, the count of small cap companies are higher. When we talk large caps, we are talking about the 100 top companies in the country. Small cap, the definition can be the 250. So 100 plus 150 mid cap plus the remaining 250, and in a very broader sense, even a longer tail after that. Okay, so that's the kind of universe which we call small caps. One challenge many of them have is they might not be scalable. They are niche players, very profitable in a certain small vertical, but that entire market might not be very good. They might be run by small businessmen who might not be very ambitious. So you need either a scalable market or the management with the drive to go after it and expand that addressable market. That's one. Second thing, many smaller companies might be a tier 2, tier 3 type of a supplier. And mm, if it's especially you're a cyclical industry, the far further you are from the end customer, the greater the whiplash when the cycle happens. Because so that cyclicality sometimes hits you, especially if you are in the middle of a capex program and you have levered your balance sheet, etc. So if you have a long term growth, economic cycle need an end in 7 years also. We can have a 10-year cycle also, right? Especially given that West wants to reduce the dependence on China, and we are actually, positioning ourselves as a credible, at least we are setting up those industries to gain share. So if we have a very long economic cycle also, these companies can actually become much bigger companies.
Thank you. Sorry, another question. A lot of people wanting to understand things. So we talked, there are a lot of positive things being said about the India growth story. We discussed through various questions, even your presentation. But any specific, I wouldn't actually call them headwinds, but something that we really need to look out, because sometimes in the euphoria, in the entire positive narrative, there are these minute details which kind of get overlooked when, it's like liquidity is good, fundamentals are good. But what would you say those two, three factors you look at within this entire positive data points that keeps a check that whether we actually going in the right direction?
So, see, any emerging market, political stability comes number one always. As of now, I think we are in a very good place, at least for the next 4 years. I'm not worried. So, that would be the first one. Second one, globally, things are still not really sorted, right? The economic growth is not really picking up in a big way, either in Europe or US or China. So, global economic growth being weak means that manufacturing export story may not happen in a hurry. Then, of course, we have wars going on. There is a proxy war between NATO and Russia and Ukraine. Middle East also is a bit unstable, which can lead to maybe crude oil price inflation, etc. So these are all worries you can foresee. Having said that, there are always things you cannot foresee also. So only thing we can do is always create healthy portfolios beforehand, because we didn't see COVID coming, right? So that's the nature of the world, and equities will be volatile when that happens.
Yes, thank you. There are always known unknown things and unknown things lurking, which we can't really predict. Very rightfully said. Another thing deviating from equity, sorry, but gold comes up in questions every time we talk about, investments. So do you really see it continue to shine? I mean, geopolitical risk will always continue, and I guess markets have learned to survive with them. So any, like your, two thoughts on gold?
I'm sorry, I'm not the right person. I don't have any strong views on it other than what I read like everybody else. So yeah, I'll probably not comment on it.
Sure, sure. Not a problem. Also, just to kind of understand, there has been this entire debate in terms of the rural consumption not really picking up, but with
Yeah,
the expectations of probably there being welfare schemes, do you see it moving, or how do you read it?
yeah. So that's a very, I would say it's at a very interesting juncture. So you know why that has suffered, right? So many people lost their earnings during COVID. Then so savings got depleted. Then the post-COVID inflation also hit them pretty badly. So they are in that rebuild phase. Uh, if you look at data points, some of them have started looking interesting or looking more positive. You can look at two-wheeler volumes; they are recovering. That's more like a proxy for rural, but of course, it's recovering from a very weak base. Some of those rural-oriented FMCG companies have started giving positive commentary. Some of the durable companies are starting to see healthier numbers. So if there is an expectation at this point that so the agri economy is the most important one for rural. So if the monsoons are good, plus maybe if some of that so there is a construction cycle that's starting to take place, and maybe government will stimulate that further in the rural setting. So if that also takes off, that's the number two industry that drives rural. So for all of that coming together, plus maybe some kicker from the government, I think it's very likely that rural would recover, or maybe it is already past the bottom.
Right. Okay, thank you for that. Sorry, I'll just take one last question before we. So AI, everybody's talking a lot about, how it could actually, maybe advance things, advance processes. There's also this lurking fear of, probably AI actually eating up jobs. So do you think so it's too premature to read into it? We're still at a development stage and it's still kind of trying to understand, or do you think there could be a possibility of it actually leading to a job crisis also moving ahead?
So at least my initial reading is as follows. So right now everybody is trying to adopt and apply AI. So clearly the hardware build out side of AI is the theme that is working, right? So with one company being the poster child of that whole story. So that's where we are. Of course, different companies, and of course the big tech companies, they seem to have some advantage also, because you need a lot of resources, a lot of data, to do the kind of compute that is needed. So these are the initial winners that is ahead of us. Going forward, yes, you are right. I feel some industries will be disrupted, and some industries will embrace it, and let's say drug discovery, or automatically interpreting your diagnostics report or scan report, etc., can be automated um, better. But yeah, some industries might be disrupted. Like it's like farm mechanization in the 50s and 60s. The farm workers couldn't do anything, but the overall economy prospered. uh, so even when we look at some of this IT businesses, we are getting the commentary. Okay, many companies are adopting AI, so that part is growing at this point. But perhaps the overall contract value for the traditional business might shrink, because some part of that workflow can be automated now. So people who are doing those type of works, maybe a call center operator, might be disrupted. So net, it depends how we gonna use this, but yeah, there will be winners and losers.
Sure. Thank you so much for that answer.
Welcome.
Kiran, sorry, I'll just take one last question. I've
Sure,
been
go
saying
ahead.
that, but I'll just take that. So definitely we talked about how, the world is looking at China plus one strategy. So definitely India is being looked as an alternative. We recently had the JP Morgan bond and DICE inclusion. We'll have the Bloomberg inclusion happening later. So besides the China plus one strategy, I'm sure you would be interacting with, investors overseas as well. So do you really see India being perceived differently? And this is just the beginning, with indice inclusion happening. Is it looked as an investment decade and investment destination and not just an alternate for China?
So mixed picture there. Okay, there are two parts here. One is investing in India for manufacturing, like an FDI type of a destination. I can say that yes, it's much better. So even within, if you look at some of those India listed MNC companies, you can see generally they have been expanding their manufacturing and increasingly being vocal about exporting a bit more from here. I may be targeting the APAC market, or so they are going in that direction. And I think especially many of the American MNCs, they are very reluctant to expand capacities in in China. So there I can pick up that trend already. Then for the Indian companies who want to export, so earlier India was not really a well-known destination to source from. So these companies, it would be very hard for them to go and get the attention of an MNC who would procure from them. Now that has changed. Now they are actually looking out for, can I build a good Indian vendor? So that conversation is much more easier based on what I hear. Of course, we still don't have the scale of China, so negotiations sometimes get stuck on the costing, etc. But some of the companies are willing, I'm okay to source 10 percentage from India, even if it is 5% more expensive, because I want to have that plan B ready. So I think directionally, from a export of goods standpoint, I think some things would happen. Of course, we are not in an environment where the growth itself is that great, but their comment is positive, clearly. And then coming to whether companies want to invest in Indian markets, it's been a bit of a mixed. I mean, I'm talking about flows into Indian equity markets. There, clearly within emerging market basket, India is becoming bigger, but emerging markets as an asset class has taken a hit because China was the largest weight and it has not delivered anything. So generally, as an asset class, it's going down a bit, and many of the foreign investors are in a bit bit of a confused state right now because they optically look at the valuation and they're not able to make up their mind. But there is really keen interest in terms of coming to India, understanding what's going on here. So they are watching. But the Indian markets are largely driven by the domestic flows at this point.
Great, thank you so much. So
Okay.
basically, even if they've not entered completely, we at least on the radar, and definitely domestic flows are very much there. So yeah, I guess with this, I'll consider that the last question. I've been saying that for a couple of minutes, but thank you so much, Kiran. I mean, it was really brilliant. To understand deeper into this entire, multi-cap strategy, understanding what could be the caveats for each of the segment and how a combination of all the capitalization helps me balance, optimizing returns as well as somewhere balancing the risk and obviously the opportunities available in the Indian landscape. So that was really great insights to learn. And I mean, thank you very much for joining in and answering all the questions. And thank you for each and every person who joined in today on a Friday evening. Thank you so much.
Thanks, Nidhi, for the opportunity, and thanks to all of you for your interest. Have a good weekend.
Thank you.